In 7 days, one company put its name behind roughly $750 billion of other people's spending. A $250 billion guarantee on a data center lease it will not own. A $50 billion lease on a Texas campus it will not fill itself. A $500 billion partnership in Korea. An investment in Ilya's Sutskever's lab. And then, in a corner of the market almost nobody watches, the price of insuring Nvidia's own debt doubled. This is not a story about chips. This is the story of a chipmaker that turned itself into the bank of the AI economy, and of the one market that flinched first. Let's go through it, deal by deal, number by number. Start with Friday, July 24th. Nvidia and South Korea's SK Group announced they were expanding their partnership into something north of $500 billion. The centerpiece, SK Telecom will build a 2-gigawatt AI factory in Korea running Nvidia's Vera Rubin DSX architecture, with the first facility coming online in 2027. SK Hynix supplies the HBM4 memory that goes inside, under a long-term co-development agreement. Chairman Chae Tae-won framed it as national capacity. In his words, competitiveness now depends on how much intelligence you can produce. That was Friday, and it was, by a wide margin, the smallest deal of the week. By Monday the 27th, the Wall Street Journal reported something with no real precedent. Nvidia was in talks to guarantee roughly $250 billion of financing so that OpenAI could lease a 10-gigawatt data center campus in southern Ohio, a site being developed by SB Energy, a SoftBank subsidiary. The guarantee covers the lease and the debt behind it. It does not cover the chips. Those are a separate conversation, reportedly worth up to $350 billion more. Total project cost, north of $500 billion. First phase, roughly 800 megawatts, targeted for 2028. Terms are not final, and Nvidia has not publicly confirmed any of it. Then the week accelerated. On Monday, Nvidia announced a long-term strategic partnership with Safe Superintelligence, Ilya's Sutskever's lab, including a direct investment and access to the Vera Rubin platform to raise SSI's compute by an order of magnitude. Sutskever's line was blunt. We have research that is worthy of scaling up. On Tuesday, the Financial Times reported that the mystery investment-grade tenant behind Hut 8's 1-gigawatt Beacon Point campus in Texas was Nvidia itself. Base contract, $19.6 billion over 15 years, rising to $50.2 billion if renewal options are exercised. Nvidia may sublease it to the neocloud firms that buy its GPUs. For announcements. For days. So what is actually being built here? Not just data centers. A financing structure. In the ordinary version of this business, Nvidia sells a chip and books revenue. In the version that emerged this month, Nvidia stands behind the loan that buys the building that houses the chip that Nvidia sells. The customer's credit becomes Nvidia's credit. That is what a guarantee means. If the tenant cannot pay the lease, the obligation does not vanish, it moves. Nvidia's balance sheet becomes the load-bearing wall under other companies' expansion plans. This did not start last week. In September 2025, Nvidia signed an order form with CoreWeave, disclosed in CoreWeave's own SEC filings, obligating Nvidia to buy up to $6.3 billion of CoreWeave's unsold cloud capacity through April 2032. If the cloud cannot find a customer, Nvidia becomes the customer. That is a demand backstop written into a contract in public more than a year ago. So what changed in July is not the mechanism. It is the exponent, from $6 billion to $250. Critics have a name for this: circular financing. Nvidia invests in or guarantees a customer. The customer spends that capacity on Nvidia chips, and the revenue comes home looking like organic demand. Mizuho chip analyst Jordan Klein put it about as directly as an analyst can. It smells like you are pre-funding the purchase of your own GPUs. Jensen Huang has called that criticism ridiculous. And there is a real counterargument. Nvidia is not handing over cash. It is lending creditworthiness, letting smaller players borrow at rates they could never reach alone. Both readings fit the same set of facts. That is exactly why this is hard. Now put the promises next to the balance sheet, because the ratio is the story. Nvidia's trailing 12-month revenue is about $253 billion. Cash and equivalents, roughly $53 billion. In its most recently reported quarter, ending April 26th, revenue was $81.6 billion with net income of $58.3 billion. A company converting profit at a rate almost nothing in corporate history matches. Market capitalization sits near $4.75 trillion. Against that, Bloomberg tallied about $750 billion in deals now in flight, on top of $540 billion already announced during 2026. These commitments are measured in years of revenue, not quarters. Which brings us to the number almost no retail investor tracks. A credit default swap is what you pay to insure a company's debt against default, the market's fear gauge, priced in basis points. At the start of July, Nvidia's 5-year CDS sat around 40. By Friday the 24th, it was 68. On Monday the 27th, the day the OpenAI guarantee reports landed, it hit 82, the largest single-day move since the contract began trading actively in November 2025. One Mizuho equity trading director's reaction, quoted in the coverage, says everything. I never looked at Nvidia CDS before yesterday. Why would I? It's Nvidia. Then the equity market delivered its own verdict, and it landed on the supply chain rather than on Nvidia. On July 28th, 4 days after that $500 billion Korean partnership, the KOSPI fell 10.84% to close near 6,024, its fourth largest single-day drop on record, triggering a market-wide circuit breaker. Our own market data poll confirms the damage. SK Hynix closed down 14.65% that day, Samsung down 13.39%. Over 1 month, SK Hynix is off roughly 42%, Micron 31%, AMD 16%. Nvidia, over that same month, up 0.4%. The partner announcing the deal fell. The company signing it did not. Here is the coordinate that reframes everything. Nvidia is not the only one doing this. On July 22nd and 23rd, at its Advancing AI event, AMD launched the Instinct MI450, 432 gigabytes of HBM4, and roughly 10 times the training performance AMD claims for its MI300X, inside the new Helios rack. And alongside the silicon, AMD said it would invest up to $5 billion in Anthropic, which is preparing to deploy up to 2 gigawatts of AMD accelerators. Same structure. Chip vendor funds customer, customer buys chips. This is no longer an Nvidia quirk. It is the industry standard playbook. The other thing the rivals map shows is diversification, and it is real. OpenAI has committed to 6 gigawatts of AMD capacity under a multi-generation agreement, with the first MI450 deployments starting in the second half of 2026. Meta signed a matching 6-gigawatt deal in February. Anthropic's compute portfolio now spans NVIDIA GPUs, Amazon Trainium, and 3.5 gigawatts of Google TPU capacity supplied by Broadcom from 2027. None of that dethrones NVIDIA. But it does explain why locking up HBM4 supply and guaranteeing customer leases might look, from inside NVIDIA, less like exuberance and more like defense. And then there is the shock that actually detonated the Korean market, which had nothing to do with America. Reporting from Korea Jungang Daily and others attributed the July 28th crash to a China chip breakthrough, specifically CXMT, Changxin Memory Technologies, moving toward an initial public offering reported around $8.6 billion, plus progress on domestic Chinese lithography. Samsung and SK Hynix together are more than 40% of the KOSPI's market value, which makes that index, structurally, a leveraged bet on exactly 2 companies. When the memory duopoly starts to look contestable, the entire index moves. Meanwhile, in Washington, On Tuesday, July 28th, Axios reported that Jensen Huang met Commerce Secretary Howard Lutnick during a broader trip through the capital, alongside meetings with lawmakers on AI policy, domestic manufacturing, and competition with China. The context matters. The Commerce Department's Bureau of Industry and Security has confirmed it is investigating potential violations involving exports of Nvidia Blackwell chips to China. Separately, reporting indicates Commerce is examining allegations that Moonshot AI accessed restricted GB300 chips routed through Thailand. To be precise, an investigation is not a finding. No determination that Nvidia broke export rules has been announced. The second pressure point is quieter and more interesting. On July 29th, SK Hynix reported the best quarter in its history. Revenue of 79.3 trillion won, up 257% year-over-year, operating profit up 557%. The stock fell anyway, and the KOSPI tripped its circuit breaker for a second consecutive day, reportedly the first back-to-back halt in its history. Why? Results came in roughly 5 to 6% under consensus, and the company's own explanation is the real tell. Long-term HBM agreements have capped its short-term pricing power. The contracts that guarantee volume also cap the upside. Stack those together, and you can see the shape of the risk without predicting anything. The guarantees concentrate customer credit risk onto one balance sheet. The long-term HBM agreements concentrate memory supply into a very small number of counterparties. Export controls concentrate regulatory risk onto a single geography. Each of those, individually, is a normal business decision that a competent operator would make. Taken together in the same 7 days, they describe a system with fewer independent shock absorbers than it had a month ago. That is an observation about structure. It is not a forecast, and nothing in this episode is investment advice. So why does this matter beyond a ticker symbol? Because the question the industry has been arguing about all year, whether AI demand is real, just got a new and much more precise version. Demand backed by a customer's own cash is one kind of signal. Demand backed by the seller's guarantee is a different kind, and the difference does not show up in a revenue line. It shows up in contingent liabilities, in footnotes, and, as we saw this week, in credit spreads. Societe Generale's head of U.S. equity strategy, Manish Kabra, compressed the whole shift into one sentence. For hyperscale computing companies, it is CDS, not EPS, that matters now. For everyone else, the practical consequence is dependency. If Nvidia is underwriting the leases, financing the chips, backstopping the unsold capacity, and co-developing the memory, then Nvidia is no longer one participant in the AI supply chain. It is closer to a clearinghouse. That is enormously efficient while conditions hold. Smaller labs like SSI get compute they could never finance alone, and that is a genuine public good for research. It is also, in plain engineering terms, a single point of failure. Efficiency and fragility turn out to be the same design decision viewed from two different directions. A few things to watch, and the first one has a date on it. Nvidia reports second quarter fiscal 2027 results on August 26th, after the close. Guidance was about $91 billion, plus or minus 2%. But the number to actually read is not revenue. It is the disclosure around guarantees, commitments, and contingent obligations, because that is where a $250 billion backstop would have to surface if it gets signed. Watch the language in the filing, not the headline on the screen. Second, does the OpenAI guarantee close at all? As of this recording, it is reported talks, unconfirmed by Nvidia, with terms unfinalized. Treated accordingly. Third, the CDS. 40 to 82 basis points in under a month is the credit market forming an opinion considerably faster than the equity market did. If that spread keeps widening while the stock holds flat, that gap is the most honest disagreement in the industry right now. And fourth, quietly, HBM4 ramp rates, Vera Rubin production volumes, and whether CXMT is still just a headline or an actual supplier by this time next year. To recap, In 1 week, Nvidia put its name behind a data center lease, a chip purchase program, a national AI build-out, and a superintelligence lab, roughly $750 billion of commitments against $250 billion of annual revenue. The equity market barely moved. The credit market doubled its price of insurance. And the supply chain Nvidia had just promised to fund had its worst week in years. Those four facts belong in the same picture. Everything in this episode comes from company press releases, SEC filings, wire reporting, and market data pulled today, with sources listed in the description. If you want the AI industry explained with numbers instead of adjectives, subscribe. This has been AI Daily.